Variable rate mortgages, fixed rate mortgages, what do they mean today? Are the rules different than they used to be? Are the differences between the two packages still the same? All that and more in the next few minutes. My name is Mike Renick. Welcome. I'm the senior broker, the team lead with Team Renick Real Estate Services. We're part of that great Keller Williams on the Water family, serving Sarasota, Bradenton, and the west coast of Florida. Welcome to the Mortgage Insider. I have a guest with me. Our guest every Tuesday morning is Christopher Kiblin. He brings over 20 years experience in the finance mortgage industry. He's fine-tuned his customer service skills to the highest level, offering Manatee and Sarasota County home borrowers unbelievable service. Their guaranteed rates promised to you is to give you a low rate on the right mortgage product, along with transparent and fair fees. They leverage cutting-edge technology to streamline the mortgage process and simplify every step. In addition to all of those things, he's just an all-around good guy. Good morning, Chris. Welcome.
Good morning, Mike. How are you today?
I am doing great. How are you?
I'm wonderful. Just enjoying getting ready for Thanksgiving.
And before I forget, because it'll get away from us, happy Thanksgiving to you and your family.
As to you and our viewers, happy Thanksgiving to all of them as well.
Absolutely. So you're going to help variable, fixed, 5-year, 7-year, 30-year, 15-year. I'm confused. Help me.
All right. So, here's the thing. And when you suggested this topic is a great topic to talk about, because here's the thing. The rates are going up. Interest rates we see going up. So a lot of times, a lot of people have questions. Hey, should I do a fixed rate? Should I do an adjustable rate? Because they think that if they do an adjustable rate, they're going to get a better rate, right? Cheaper rate. And so that's why they want to do the adjustable. So, great point of what's the difference between a fixed rate and a variable rate. So, when you do a fixed rate is going to be locked in for whatever term that you sign up for. And there's many different programs that you can do. You can do a 10-year fixed rate. You can do a 15-year fixed rate. You can do a 30-year fixed rate. So there's multiple choices with the fixed rate option. Your rate will never change. The confusion comes into a lot of times if people want to do an adjustable rate, and they're kind of, back in 2008, before the market collapsed, adjustable rates were quite scary, actually. People weren't quite sure where they were going, what rate they were going to get. But since then, there's been a lot of changes in the process of how that goes. So now we have different programs that are basically kind of, set in stone that we have to follow, just because we don't want the customer to have a payment shock if you're doing a variable rate. Mm-hmm. So a variable rate, what that means is, let's see, there's different terms for those. You have a 3-year variable rate, you have a 5-year, a 7-year, and a 10-year. And what do I mean by that? So for the first, let's just say it's a 5-year arm. So what that means is that it's locked in for 5 years and cannot adjust for 5 years. Okay, so let's say you locked in at 4% on a variable rate. Well, that first 5 years, it will never change. It can't change into year number 6. So in year number 6, there is a cap, okay, and that's a 1% cap. And what that means is that rate can either go down to 3% or it can go up to 5%. It can go one way or the other of 1%, but it can't go above that. So you can't just be all of a sudden be, at 20%. So it is a cap of 1%. So, and then it can change every year on a date that it changed the year before. So every year. Now there is a max on that. So the max that it can ever go up is 5% of whatever you locked your loan in. So let's say that you locked it in at 4%. The max rate can be 9%. So the way that works is, let's say, go back to our example of the 5%, let's say the 4% on the 5-year arm. So year number 6, it goes to 5%, right? Mm-hmm. But then year number 7, it can only go up another point. Okay, so then it goes to 6%. So once you hit your cap of 9, it will never go above that. It can only go down. But it can only change 1% of whatever the following year was. So kind of give you a little bit like another idea. So let's say that the first year it goes to 4.5%. Well, the following year it can't go any more than 5.5%. Mm-hmm. So it's only the 1% of whatever it locked into the last part. Okay. So when clients come to me and they ask me, well, what do they think? Should I do a variable? Should I do a fixed rate? What's the best option for me? These are going to be questions that you kind of need to have with the client, because the client needs to know, hey, are you keeping the loan for the next 30 years? That's usually where I have a conversation with them to say, look, in 30, if you're going to keep the loan for the next 30 years, maybe the ARM is not the best rate for you, because and if you're going to keep that loan, then that rate, if it goes up to 9%, then now all of a sudden you're paying 9% instead of, let's say, you're locking in today's rate at 5%. So usually the best way to do ARMs are people who know that they're going to sell their homes, and like let's say they do the 5-1 ARM, they're going to sell their home in the next 5 years. They just say, I know I'm going to be gone in 5 years, I'm going to sell it. So that gives them the better interest rate for the next 5 years. Or they're going to pay off that loan in the next 5 years. Let's say, hey, you know what? My goal is to pay this off in the next 5 years. I'm going to sell a couple homes up north, and then I know that it's going to be paid off. So let's get the better interest rate there. Okay. It really depends on how long you plan on keeping the loan and what's the best benefit for you. And each client is different. So, it's got to make sense for them. Now, one of the other big things is that, when qualifying comes around, we don't qualify underneath the interest rate that they are locked in at. We're actually going to qualify them. So that same scenario of the ARM at 5-1 ARM locked in at 4%, you're actually going to have to qualify at a 9% interest rate, because they want to make sure that you're going to qualify underneath that 9%.
That's a big change from before, is that not, Chris?
Correct. Yeah. Before you used to be able to just qualify with the 4%. Okay. Now they're going to qualify you underneath the 9%, whatever that max rate is, because they want to make sure your payment, you can handle that payment if it ever gets to that point. Mm-hmm. So there's some big differences, and there's really some things that, really in detail, that there's a lot of questions that you need to be asked when choosing these types of rates, because it can be very confusing.
When someone sits down right now and they begin to evaluate the two products, so you've got the same client twice. So credit rate's the same, credit history is the same. Is there a rough number that the interest rates would be different, the fixed versus the starting out ARM?
So usually it could be anywhere from 0.5 point to a point difference. On the adjustable rate is going to be lower, about 0.5 point to a point difference depending on the term. One of the things that we're seeing though is in the marketplace, the investors who buy mortgage-backed securities, they're actually getting away with, they don't really want to do ARMs anymore. So we're actually seeing a little bit more of a higher ARM rate than we used to see. They want the 30-year fixed, nice conventional FHA mortgage. So what's happening is you're seeing a difference in ARM rates actually go up more than where they used to be. There used to be a point where you could get an ARM almost 1.5, 2 points cheaper than a fixed rate, but it's actually gotten a lot smaller in the last probably 6 months, 8 months.
So it really comes down to risk reward. We're getting a little bit of feedback on risk reward in terms of, do I want to take a little bit lower percent now with the risk that it could go higher, or do I want to lock in something relatively close? It sounds like with fixed rate. Correct.
So that's the conversation you need to have with them is like, really, does it make sense to you to keep that, especially if you're going to stay in that home for the next 15, 20, 30 years, an adjustable rate probably doesn't make sense for that person, because then I can give them other options on how to pay it off faster with keeping that same rate.
If someone were to apply for a fixed rate, 15-year fixed loan interest rate is cheaper than a 30-year, correct?
Right. Yes, because the shorter the term, the shorter the better interest rates are going to be. So even like a 10-year is going to be better than a 15-year, because the mortgage company is actually going to get their money back faster, so they can lend it back out. So the shorter the amount of the term, the better the interest rate. So given all of the factors, this is not an easy topic. It definitely is complex. So we would encourage someone to reach out to a bright mortgage broker to walk them through that. And Chris, in your case, what phone number would they use? They would use 443-668-5727. Excellent. That's all I need to know about mortgages when I've got a good guy I can turn to get the answers to that. Chris, thank you. Anything else you'd like to add? Nope. Just have a happy Thanksgiving, everybody. All right. My feelings also. Again, Chris, thank you. We'll see you again next Tuesday morning. All right. Thanks, Mike. Yep. Take care.